Welcome back to FX Street. Certainly glad you could join us. Thank you, Ed Ponzi. He's a fantastic guy. My name is Adam Rosen. Welcome to FX Street. Thank you very much for joining us on November 26th. Happy Thanksgiving for all of those of you having Thanksgiving. It's certainly a pleasure to be here. We have one of my favorite topics to talk about today. You should see the chart, the Euro-Dollar daily chart in front of you. If you cannot see the chart, you hear my voice at any time, please do not hesitate. Let me know, and I will reset the system on my end. However, without further ado, what we're going to talk about today, I think, is one of the best, or really the most helpful, the most useful technical indicators, not only in all financial markets, but specifically with foreign exchange markets. If I had to pick one technical indicator, if I was only allowed to use one, well, maybe outside of trend lines, my choice would be this, Fibonacci. And you may be familiar with it. It's certainly a very fascinating technical indicator, and it can be very, very helpful. Couple quick facts about Fibonacci for those of you new to this indicator. Here's a Wikipedia article that talks about Fibonacci. And the Fibonacci numbers, if we start at 0 and we add 1, and every time we add 1, we add the current number to the last number and add the two together. So 1 plus 1 equals 2. So we start with 1, and then 1 plus 1 equals 2, and then 2 plus 1 equals 3, and 3 plus 2 equals 5, etc., so on and so forth. And what we end up with is a sequence of Fibonacci numbers. Now, these Fibonacci sequences and the percentages of these Fibonacci sequences can be found in all different shapes and forms. Here's a quick little shot from Google Images. Fibonacci numbers and sequences can be found all over nature, in the universe, within our own human body, etc. But they are, for our purposes, very, very helpful in terms of price anticipation, anticipating retracements, and anticipating projections where we could go. Now, I think it's very apropos that we talk about Fibonacci today because of what happened yesterday. For those of you following the foreign exchange markets over the past 24 to 48 hours, I'm sure you noticed a couple things. Well, the yen's been kind of strong. The Aussie and the Kiwi have been kind of weak. But the big mover has been the dollar breaking very significant lows, forcing other currencies to break very significant highs. We can see this on a lot of the dollar crosses. And the reason I mention this, and the reason why we're so lucky that this happened, is because I found that Fibonacci is best used in trending market conditions. Now, we're looking at the Euro-Dollar daily chart, and every time frame, we either have a range-bound or trending market condition. On the daily chart, we have a trending market condition. What's trending? Trending is when the market, over time, consistently makes higher highs or lower lows. It has a specific direction. However, we can see within the two diagonal lines pointing somewhat to the downside, within this long-term trending market, trending to the upside, Euro-Dollar daily chart, on a shorter-term basis, we had a range develop. And the market, you'll notice, will fall into these cycles of trending to range-bound and range-bound to trending. And within a trending market condition, what we see here, there are smaller range-bound markets. And within the smaller range-bound markets, there are even smaller trends. So it's a constant oscillation between range-bound trending depending on what time frame. Fibonacci, I found, can be used most effectively during trending markets. Because Fibonacci tool, and I'm going to show you exactly how it works, is used to anticipate future support and resistance levels based on the Fibonacci percentages. Fibonacci sequence is what I'm trying to say. And these are just a name of the few of the most common Fibonacci percentage retracements. Well, the most common is the 38.2%, the 50%, and the 61.8%. There we go. Those are the most common. Traders will also use a 23.6% and a 78.6% as well. Now, in addition to that, traders will use sometimes a 100% deviation of it, meaning 123.6%. And I'll show you how these exactly work. The question is, why connect the two lows and the bottom line sloping down? It's a great question, Bill. What we do is I like to connect significant highs and significant lows. And what happens is in an uptrending market, it's most important to start with support. I'll show you how we drew the long-term support line. Drawing the long-term support line, connecting the most significant low, connecting it up to the next most significant low, Uptrending markets always start with support. That's the rule of thumb. And downtrending markets always start with resistance. Well, on a long-term basis, we see the markets obviously trending to the upside. We start with support, and then I try to find resistance to see if it's parallel. Doesn't always happen, but when we can find a parallel resistance to our established support line, it's an extra level of confirmation. The same holds true in downtrending markets. In downtrending markets, we first start with resistance connecting significant highs. A few different ways. I chose to disregard that long candlestick wick in the middle. That's November 11th. Connect them down to the next most significant lows, or highs, I should say. And then I just coincidentally found that the support level matches up. So the support level that I drew in this downtrending market is a little bit of a source of confirmation, just to show us that the resistance level was accurate. We actually connect the most significant highs. It works a little bit better that way. However, needless to say, we saw yesterday's daily candlestick on the euro-dollar chart, which hit highs of 150, 144. We did not trade above that level or at that level in quite a long time. In fact, we have to go all the way back to August 11th of 2008. Over 1 year that the euro-dollar did not make new highs nor new lows, not at those levels. It happened yesterday. Now, certainly it's very important because imagine from October 2008 until November 26, 2009, imagine every single trader that bought and held onto the trade, the euro dollar. They didn't use the stop and they had enough margin, or, very simply, we just held on to the loss. Well, now every single trader that has bought and held on to the euro dollar since August of 2008, the moment that we crossed to new highs above that 150, basically the 150 level, 150.62 actually, were the highs October 26th of this year. As soon as we crossed above that high, every single long became profitable, and every single short trade became unprofitable. And when we hit that dynamic in the market, it certainly is very, very powerful because it tends to lead to real breakouts, real vertical ascensions and descensions in the market. Now, this was mostly caused by the U.S. dollar. Now, let's take a look at the Fibonacci tool and see how it can be helpful. I mentioned 123.6 because sometimes you'll see traders, they will use the Fibonacci sequences, the 23.6, 38.2, 50%, etc., add 100% to that because this 100% or the 123.6% is still a Fibonacci sequence. It's still a Fibonacci projection, so to speak, and it can be useful to find retracements and moves and looking for moves moving forward. Let's take a look. I can draw the charts a lot better than I can speak. And I'll tell you, I'll answer the question. I would not, well, on a short-term day trade, I think we can find the breakout, but there's a better way to handle breakouts in the foreign exchange market. Let's first take a look at quickly how Fibonacci is used. Now, we're going to identify this low over here. The market's already moved up by quite a bit. And actually, you know what? We'll go back. Take the most, and I'm looking at a chart going back to March of this year. So pull up a daily chart on your own screen if you like. Go back to around March or April of this year and find the lowest low. In an uptrending market, you always want to start at the bottom. In a downtrending market, we always want to start at the top. In other words, we want to start at the beginning. Beautiful. Okay. So the lowest low I see are the lows of 128.85 on April 22nd of this year. Okay, so take the lowest low, click our Fibonacci tool. Almost all foreign exchange charts offer it one way or another, and click it and drag it on up. And again, we're starting at the bottom in an uptrending market, starting at the beginning of the trend. This we identify as a trend. Remember, not a range bound market. We're looking for the market to go higher, 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 or lower, lower, lower. Well, what I'm doing is I'm very simply drawing the Fibonacci lines from the lowest low to the highest high in this trend. Now, what constitutes a trend? I could just as easily draw the Fibonacci lines even up, even higher, and consider that a trend. That is accurate as well. However, for our purposes, what I want to do is find a nice piece of the move before the market retraces significantly. Now, it's all a question of time frame. This move from the lows of, what do we say, April 22nd, more or less, to the highs of June 4th, this represents a big move and a big retracement. If we were to look at the same move on a shorter term time frame on a 4-hour chart, we would have found other retracements that had occurred. But we're thinking in terms of the time, context of our time frame. Our time frame for these purposes is a daily chart. But if you're wondering, Fibonacci is also excellent for smaller, shorter term time frames as well. To an extent. I'll show you how. Okay, so we took the lows of April 2009, drew the Fibonacci levels up to June of 2009. Now the market retraces, and you'll notice that when I drew these Fibonacci lines up, there were lines that emerged above us and lines that emerged below us. Let's forget about the lines above for a moment. We're going to talk about that in just a few minutes. But first, take a look at the lines below. Well, we had a move from the low of around, what do I say, what, 129 to the high of 143. That's about 1,400 pip move. Well, now now what we want to do is subtract percentages of that 1,400 pip move up. What percentages do we use? On the right-hand corner, we can see 23.6, 38.2, 50%, 61.8, 78.6, and 100% obviously brings us back to the beginning. So on the Fibonacci tool, it automatically will plug in normally 38.2, 50, and 61.8. I add in 23.6 and 78.6. Just add in a couple extra factors if you can. A lot of Fibonacci tools will let you do that. At any rate, after the market moved up almost nonstop, 1,400 pips from the low euro dollar, 129, imagine if we bought it back there, to the highs of 144 or so, then we subtract 23.6% of that. Well, can anyone do the math of what's 23.6% of 1,400 pips? I can't. I'm guesstimating it's what, 300 pips more or less? Well, the computer model or the calculator, the Fibonacci calculator, does that for us automatically. We subtract 23.6% of that 1,400 pip move, and it generates the Fibonacci line. Subtract 38.2% of that move, and it generates the second Fibonacci line. In fact, it calculates all the lines. The 78.6 represents exactly 78.6% of this entire move subtracted back down. Well, we do not know where or which Fibonacci level the market is most likely to find support or resistance. The Fibonacci tool simply calculates 1, 2, 3, 4, 5 different levels within 1,400 pips. We have 1,400 different pips at which the market could find supports. Well, this has broken it down to 5 distinct levels. From this point moving forward, we want to A, wait for the market to retrace, and B, we want to look for signs of confirmation. Signs of confirmation are long candlestick wicks, double bottom. Over here we saw a triple bottom, actually almost a quadruple bottom at one point. We want to see reversal points. It's at this point that we would plug in another indicator like our RSI, the Relative Strength Index, or the Bollinger Bands or the MACD on a shorter term time frame and look for additional signs of a reversal. After all, again, we do not know if the 23.6% Fibonacci retracement level will represent support. That was around 140. It's not a bad guess considering it's a large round figure. But take a look at the first candlestick that hit that level, crossed right down through it, closed below that level, and closed at a new low. Now, Fibonacci is a science of approximation. I would not expect the market to stop exactly at the figure, exactly at the 23.6% Fibonacci level. However, it usually comes very, very close, or pretty close. But again, look for other signs. My favorite to look for is double bottoms and double tops. We can see over here a nice double bottom, the first bottom. These lows, let me just adjust my charts here so we won't scroll away, okay? So we see here, we drew the Fibonacci lines up. The first low, long candlestick wick at the bottom, that's nice, 137.92, that was on May 28th of this year. The market rallied up after that, obviously, came back. This still constitutes a double bottom pattern, though. The market was not able to cross back below, hit 138.05 on June 8th, rallied back up. We did not make new highs. If we made new highs, we would certainly have to move the Fibonacci levels up again to adjust for that. Remember, the lowest low to the highest high. But after hitting 138.05 and after bouncing back to the upside, another long, actually 2 candlestick wicks came down to 137.47. The close at 138.34. The previous candlesticks closed 137.86, closing prices very close to the 38.2% level. Now, if eventually we had crossed down to 50%, I have to ignore 38.2% and consider a lower Fibonacci level. But we have 1, 2, 3 bottoms, 3 long candlestick wicks, all telling us that the market, for some reason or another, is stopping very close to the 38.2% Fibonacci retracement level. Coincidentally, or maybe not coincidentally enough, is very close to the 138 figure. Those are the different signs that we're looking for. Double bottom patterns, long candlestick wicks, hopefully close to a large technical figure, a large round figure. Trend lines, if they intersect, are also very important. Now, from that point moving forward, we know in a trending market condition, we expect the market to eventually make new highs. Before we do that, let's actually take the steps. These are the steps how to trade. Let me take this in. How to trade, okay, with Fibonacci in trending markets. Remember, trending markets make higher highs or lower lows. No range-bound markets. Markets that don't make higher highs or lower lows, Fibonacci found is not very, very helpful. Not on that time scale. So only trending markets. So the first thing we want to do is, assuming an uptrending market, in the downtrending market, we just reverse the steps. Uptrending markets, okay, so we measure, okay, from lowest low to highest high. Okay, that's the first thing we did. Now, market pulls back, and then number two is we look for confirmation at certain Fibonacci levels. Okay, if and when we find a confirmation, we sit on the third bottom, we say, hey, the lowest low is 137.47. Well, before that was 137.55. I don't think it's going to go much lower. At that point, we would take a position. We would basically go long near low of double bottom pattern with stops placed below lows and with breathing room. You have to give the market a little bit of breathing room. So give it some room below the recent low, because sometimes the market is so nice to just make a little bit of a lower low. Now, from that point moving forward, we hold on to the trade. Hold on to the trade. Reason being, we're in a trending market. We're trading with the trend. The trend is your friend. Our trade has told us so far we're right. Let's say we bought the second and third bottom over here. We're long right around 138. We go up to around 142. Hey, we've got a 300-400 pips of profit. It's tempting to take profits. But remember, trending markets have the tendency to continue to make higher highs. An object in motion tends to stay in motion. An object at rest tends to stay at rest. Well, the euro dollar is an object in motion. For whatever fundamental reason, more traders are buying the euro and selling the dollar. Now, I don't want to miss these questions. At that area, it shows a small head and shoulders top as well. Absolutely correct. We're talking about what we're referring to over here, the first shoulder high of May 22nd, the head at the top, and then the top that's June 2nd, and then the second shoulder arguably around June 11th. This smaller pattern, and it's important to mention the head and shoulders pattern is a smaller pattern within the long-term trend, so it's okay. Head and shoulders typically break in the opposite direction of the head. The head's at the top, so we certainly would expect a break lower. In this case, it did not occur, but the long-term trend is certainly very much to the upside. Now, Harley mentions for the extensions, you simply add subtract 100 from the retracement level. It should be 78.6, not 7. What did I type? Did I type 76.4? I apologize if I did. It's supposed to be 78.6. You are correct. Yeah, I did type 78.6. Yes, 78.6 is the correct level. Now, for Harley's question, extensions, simply add subtract 100 from the retracement level. Not exactly. I mean, maybe on some chart packages you could. I'll show you what I do. Everybody should be able to see this little pop-up window. This is in the MT4 MetaTrader charts, but there's a few different ways. You'll notice over here we have the 23.6%. The description is, we call this a 23.6% Fibonacci level. On the left-hand side, the actual calculation. How do we write 23.6%? 0.236. 38.2%, we write 0.382. The calculator does all this for us. But the question is, how do we calculate extensions? Take the same Fibonacci levels. What I do is just add a negative next to it. In other words, instead of 23.6 or negative, instead of 0.236 or 23.6%, I write negative 23.6%. The reason being is because what the calculator does is we told the calculator, draw the Fibonacci levels from the low to the high. Now we told the calculator, measure 1,400 pips. The calculator then automatically subtracts 23.6% and subtracts 38.2%. So we have to fool the calculator. So when you subtract a negative, it becomes a positive. So to answer your question, Harley, what I do is I just add a negative symbol next to every one of the Fibonacci levels. And instead of subtracting, it subtracts the negative and adds it. Now, why is this important? Well, moving forward, remember, Fibonacci retracement levels, when we pulled back, found new support, a higher support level within an overall uptrend. Now, the question is, where could we go once we break out? I'm hoping for a breakout because remember, we went longer on 138. Well, the highest high at that point was 143.36 on June 3rd. Remember, that was a high that we used to draw our Fibonacci levels. We're expecting a breakout above that. The market does break out. We never got stopped out. And then we see the market break to a new high. Let me zoom out just a little bit to give everyone a little bit of context about what we're looking for. Okay, so we see the market break out to a new high, goes up to the 23.6% Fibonacci projection level. Remember, instead of subtracting, we add 23.6. So just add 23.6% of the former trend to the former high, and that becomes the Fibonacci price target, the projection, or sometimes called the extension. Simply add 23.6%, and this tells us that the market may find resistance. Eventually, we're going to find a top at the 23.6%. That's at 146.70. Well, the market charged right through there. It seemed not to honor that level at all and pulled back down. So that, in my book, tells me that maybe not the case. Well, the next level is at 38.2%. That's at 148.80. Well, the first time we touched that, well, that never really touched it. Then we came down. We came up again and charged right through it. Remember, looking for double tops and double bottom patterns. But take a look at the 50% Fibonacci projection level, which is approximately 150.60. Well, what were our highs? 150, the highest highs we saw, 150.62. 2 pips above our projected resistance level. Now, what makes this 50% Fibonacci level different than any of the others? Remember, as the market goes up to 23.6, it charges right through it, falls back down, doesn't look like it had any kind of influence on the candlesticks. 38.2%, we charge up, go right through it, and right back down. But now we see here what's new, a double top pattern. We hit highs of 150.62. We hit more highs around 150.48. It's near a large round figure. That's 150.50. And that tells me, any more evidence? Hey, I think this could be a top. Now, it's a little bit subject to interpretation. A lot of traders may say, hey, you know what? That former top was a Fibonacci level at all. It very well could be. However, I like to use the most obvious examples. Now, watch this. If we take the same Fibonacci sequence from before, remember 1,400 pips from our original level, drag the lows up to our new lowest lows. Remember, where Fibonacci was over here, I'm going to draw horizontal lines. Remember the 38.2% Fibonacci retracement level? That dotted line represents what that 38.2% is. Now I'm going to drag the Fibonacci levels up, and we can see here what we're doing is basically just duplicating 1,400 pips. We went up 1,400 pips in the first leg. Maybe we'll go up 1,400 pips in the second. Well, the second leg, if we had doubled the move, that would have brought us to 152.20. That does not always work, but sometimes it does. In any case, we must redraw the Fibonacci lines. Remember, we have our new lowest lows. That was the 38.2% Fibonacci retracement level. Take our new highest highs, remember the double top? And that told us that 23.6%, that could be our new support. It did not. The market crashed right through. But the 38.2% at 145.75 roughly, that came very close to the long candlestick wicks down to 146.24. Now, it does not always occur exactly, and I certainly could have made a mistake along the way. We can test other levels just to be sure. All we're doing is waiting for the market to make a higher high or lower low. Let's assume that we were right, though. So we're going to draw the Fibonacci levels up, and then we're going to scroll forward. Well, we can't scroll forward now because this is obviously today. But the Fibonacci projection levels, if you're curious where we could go, let's adjust this to 156. Maybe a little bit more than that. And I'm going to get to these questions as well. I do not want to ignore the questions because they're all great. Now, if you're wondering where the euro dollar could go, well, once we rested at the 23, or was it that was 38.2%, 160. Let's try euro dollar 162. All right. That's fair enough. Now, these Fibonacci projection levels, again, tell us where the market may find future resistance. It's a nice, easy way to force us to hold on to long-term trades. And also, we can move our protective stops up to the next most significant lows as long as they held above the Fibonacci levels. If the euro dollar continues in its current path, the 23.6% Fibonacci projection level at 153, 38.2% at 155.5. The 50% intersects with 157. Remember, I love when Fibonacci intersects with horizontal or diagonal and horizontal trend lines. Now, questions. Let's go back. Now, what do you think about the 86%? Is it useful? I've read some Fibonacci sequences include the 86% as well. I don't use it though. I stick with the percentages that I've given you: 23.6%, 38.2%, etc. Now, furthermore, Fuji says if you add 23.6%, 76.4, etc., equals 100%. There's a lot that's been written. I don't want to tell you no because I don't know necessarily the answer is no. There's a lot of math and a lot of conservative and otherwise math that's been done around the Fibonacci sequences. You can take this to the nth degree. What I use in foreign exchange trading is the most simple approach to Fibonacci levels, very, very simply because I also want to see the levels that other traders see. Sure, we can probably surmise another Fibonacci level within the level, 38.2% of 38.2%, of course. However, I know that the majority of the traders out there with basic chart packages probably only see 38.2%, 1561.8%. There's a little bit of self-fulfilling prophecy that goes into financial markets. If I think we're going to find support here and you think we're going to find support here, I think eventually there will be support there, at least for some period of time. So I like to use the obvious examples because I want to see what most other traders are saying. Now the question is, if price stopped at 38.2%, does price then go to the extension of 130.8? Is that 100? It's an excellent question. There are theories, there are schools of thought that says, hey, the market pulled back, and I'll give you an example, and as I clear the chart here, I'll give you an example and ask your opinion. There are some schools of thought that say, hey, let's go back to our original lines. We drew from the lowest lows to the highest highs, and the market pulled back to the 38.2%. It failed to go to 50. It did not go to 61.8, 78.6. In other words, it was a shallow retracement. We didn't come back down that much. Well, there's some traders out there will say, hey, the market didn't pull back so much. That means there's a lot more buyers than sellers. That means that when we go up, where could the market go? Could it go to the 23.6% Fibonacci projection level on top? Or because there was so many buyers that held the market and the market only came down to 38.2, that means the market has inherently a lot more strength and it could go a lot further. It could go to 61.8%, it could go to 78.6%, it could go to the 100% projection level. That's one train of thought. And I agree with that. It makes sense to me. There's another train of thought which also makes sense to me. The other train of thought is that there's a qualified amount of pips or points within a market at any given time that the market has a probability to move. After all, especially when we look at a euro-dollar pair, the euro-dollar, someone that told me at one point, represents around 50% of all the volume in the foreign exchange market, and that's huge. When we're looking at any market as voluminous and as massive as the foreign exchange markets, we don't see the euro-dollar doubling overnight. Thank goodness for that. We don't see the euro-dollar going from 150 to 3. The euro-dollar, percentage-wise, doesn't really move that much. We went from 149 to 150, and this feels like a big move. Well, if we're using 401 margin, it is. But in a percentage basis, it's not. Foreign exchange currency pairs actually don't move that much. The reason why we get so much leverage is because we need that leverage to make a lot of money on 100 pips. 100 pips is 1 penny. If we bought a stock and sold it after making 1 penny, it doesn't really mean that much to us. Now, getting back to our point, I don't want to get too distracted here, but getting back to our point, there's one train of thought again that says, hey, if the market retraces and has a shallow retracement, that means there's a lot more buyers, and that means the market should go up a lot more and probably go to one of our higher Fibonacci levels, like the 50%, 61.8%, even higher than that. The other train of thought is because the market has enjoyed so much volume, there's only so much the euro-dollar probability-wise, if we were to plug the statistics into the market, the probabilities, what's the probability of the euro-dollar going 1,000 pips in one day? When was the last time the euro-dollar moved 1,000 pips? Did it ever move 1,000 pips one day in 1 24-hour period? I don't think so. I can't remember there being a time. I know other cable yen, that's a different story. What's the probability of the euro dollar moving 500 pips in one day? Not that good. Probably, 3%, maybe 3% of the year the euro dollar makes 500 pip moves, maybe even less than that. What's the probability of the euro dollar going 20 pips a day? I'd say almost 100%, pretty much 100% of the time. Well, the euro dollar from late April to June went 1,400 pips up. Now, that is considered a pretty substantial move, especially for the euro dollar. My thinking, the second side of the case, or the second side of the coin, is that, well, we already went up 1,400 pips, maybe in a total probable move of 1,500 pips or 2,000 pips. We've already gone up so much, most of the buyers have already exercised their buy orders. Most of the sellers in those shorts, they've gotten out of the way, they've closed their trades. There's not much more reason for the market to go up. So if we retraced only back to 38.2%, after moving up so much, this shows us other traders saying, well, maybe we're not going to go up as much. I happen to subscribe more to the first train of thought, meaning that if the market has a shallow retracement, I think it can go up a lot more, because that means that the market didn't pull back that much and more buyers, well, you could think of it a different way in terms of the buyers making money and the sellers making money, but it shows us that there's a lot more buyers versus sellers. That's a little food for thought. In my studies so far, and I've done a lot on, TradeStation and things like that, I have not found a reliable correlation one way or the other. So we're reduced to technical analysis, looking for double tops, double bottom patterns. Now, Bill says, could you explain why you didn't choose the September 21st high? Let us see September 21st high. September 21st, I see right over there. Actually, yes, you are September 23rd. I see the highest high. We very well can. In measuring the first move, though, I want to look for, and this is a little bit looking at a piece of art and a painting, it's a little bit different for everyone. I want to look for the first time the market severely breaks down. One other way to quantify this is to say, well, let me draw a trend line connecting the significant lows. Can I zoom in here? We see here. If I can draw a trend line, which I can, draw a trend line connecting the significant lows, this retracement that we ended up using the former highest high, why did I use that? Because I always try to visualize the uptrending support line. If we broke the support line, then I want to use that highest high as the Fibonacci top. If we did not break that support line, I'll continue to ride the market higher, watch the market go higher until we see a substantial pullback. So my definition of substantial pullback is we break a shorter term trend line. It's a little bit of art, a little bit of science. Now, Charlie says, do you use Fibonacci clusters? I do not. It's another application. There's no reason why I do not, except for there's just so many hours in the day. But there certainly are a lot of benefits to using different Fibonacci. Time sequence is also very, very popular. Moss says, I know that Fibonacci works and its main tool. Do you think it works because all traders respect it, or there's something beyond that? The answer is yes and yes, I believe. I think it works as a matter of self-fulfillment, meaning that it's a self-fulfilling prophecy is what I'm trying to say. That if I believe the market may stop at 38.2% and you believe that, etc., I think there's more of a likelihood it's going to happen. Moreover now more than ever, and moreover in the foreign exchange market than any other market, because so much of the market is dominated by program trading. I heard a stat a couple of years ago. I don't doubt it to be true at all. 60% I heard of the trading in the New York Stock Exchange is program trading now. It could be more than that. Now, all those program trades, a lot of those program traders out there, what a program trader is someone who studies the market and designs some sort of algorithm, some sort of computer program that will watch the market go up and down, calculate Fibonacci levels as one of the staples of these program traders, and then say, okay, I'm going to buy every time it hits 38.2%. I'm going to sell every time it hits 23.6%. They use these Fibonacci sequences as well. Trading floors, not trading floors, but the actual traders, those individuals that press the buy and sell buttons for large orders, I'm sure they're aware of that. After all, Fibonacci is available on free charts, so we have to assume everybody has it. So I think it's a question of Fibonacci works because other people watch it. I think it also works. Well, I'm a believer that there's a little bit, I don't want to say the word magic, but there's something that maybe we can't necessarily explain, but there are certain mathematical sequences that exist in nature. Some may disagree with me. I completely respect you if you do. However, I happen to subscribe to the fact that maybe there's a little bit beyond what we know that tells us why Fibonacci works. I'm an optimist. Now, what is the smallest time frame under which it works? I think it's a great question. I would not personally, I'll show you what I mean. Let's go to a euro-dollar chart. And Bill also asked, can we find a trade that worked against us? I should not have a hard time in finding that. Let's go to a shorter time frame. Let's go to a 4-hour chart here. 4-hour chart, euro-dollar, the current 4-hour chart. Let me adjust my charts here. Auto scroll. Okay, so the current 4-hour chart shows us euro-dollar as we just broke the new highs. That's encouraging. I'm going to try to find trades that worked and did not work as well. Take the lowest low. Well, I think the lowest low that we can see over here goes back to 146.24 lows November 3rd. That's euro-dollar. Draw the Fibonacci levels up to those highs. And we see, let's zoom in here. This is a 4-hour chart. Remember, the trend is your friend. Long-term traders, they want to focus in the same direction as the chart. So do short-term traders. Well, this is a euro-dollar 4-hour chart. We drew the Fibonacci levels up to the highest highs that we saw after that significant lowest low. The lowest low, again, were the lows of November 3rd to the highest highs November 11th. November 3rd and November 11th. 23.6% quickly crossed back below. 38.2% quickly crushed back below. Long candlestick wick emerges near the 50% level. We hit the lowest lows of 148.21, then rallied back up. Again, another long candlestick wick, slightly lower low, 148.07. But notice, the long candlestick wicks show the candlestick from the open to the close, the high to the low. The thick part of the body represents the open to the close. I like to focus in on the closing trades, closing candlesticks. So even though this candlestick, and this is on November 17th, the long candlestick wick went down to 148.07, we closed at 148.56. So long candlestick wick emerges, another one even lower than that. Guess what the low of that one was? 148.00. 3 long candlestick wicks. None of them failed to break the 148 level. The last one exactly touched the 148 level. And then we saw a massive rally to the upside. This was a very, very nice level to suspect. It's a 50% Fibonacci retracement level on a 4-hour chart. It's a very nice level to suspect where we could go. Well, if we decide to buy, to go long near the 50% level, obviously we want to place your stops below the 50% Fibonacci level. Remember, we want to also place the stops below the most recent significant low. The last low was 148.07. I always like to place my stops on the other side of the next large round figure. So the low of 148.07, I'm going to place it below 148. Well, we never got stopped out there. From 148, the market moved up a lot. How do we know we're right? Not until the market breaks to a new high. 150.48 were the former highs of November 11th, 11/11. We crossed the new highs. Look where we stopped. We hit highs of 151.44, which is almost exactly the 23.6% Fibonacci projection level of that former trend. So we take the trend, the low of 146.30 to the high of 150.48. We'll call that almost exactly 400 pips. Actually, about 410. 400 pips. Retrace back 50%. Well, that's a 200 pip retracement. We're able to go long here at 148. And then we hold on. We don't know we're right until we cross above. Well, 23.6% of 400 pips is what? Another almost 100 pips. So from 148, hopefully we're able to take profit, maybe near the 151 level. Not a bad trade. This is on a 4-hour chart. Let's look now at a 1-hour chart. Now, this is all to answer the question, what time frame can we use? And I would say that my choice would be not to use anything less than 1 hour. 1-hour charts or more. I don't like to use something less than 1 hour. Not to say it doesn't work, but I think there's a little bit, we lose a little bit of the accurateness, the level of accuracy on charts if we go less than 1 hour. That's my personal philosophy. Now, take the most significant lows. Remember, exactly 148. That was our Fibonacci resting point. That was our Fibonacci 50% level. That's our new support. That's our new lowest low. I've now gone to a 1 hour chart, but I remember 148 was important. So draw the levels, the Fibonacci levels from 148. This is a 1 hour chart to the next significant high. Remember, on a 1 hour chart, this is a trend. On a 4 hour chart, on the daily chart, this is a range. But this move here from 148 to 149.99, almost exactly 200 pips, 199 pips from low to high, that represents my short-term trend. We pulled back, we crossed immediately, almost immediately below 23.6, almost immediately below 38.2. Long candlestick wick. I think the long candlestick wicks are probably the best way to use Fibonacci. Look for confirmation of Fibonacci levels. I love it when it happens. We never crossed below 50%. If we're able to go long, well, we had a double bottom pattern if you count that 38.2% test. Sometimes you'll see the market walk up Fibonacci levels. We found first support at 50%, the second support at 38.2%, and then another support maybe 23.6%. We also have an upside down head and shoulders. Needless to say, we rallied back up 23, 38, 50. We found resistance in between the 61.8% and the 78.6%. So, to answer your question, Bill, this is an example of how Fibonacci retracements work this time pretty well, but the Fibonacci projection levels did not give us a really accurate level where to take profits. However, I would say adding our own human element into this, I have a little personal rule of thumb. If I'm in the money, if I have a trade, if I was lucky enough to go long down here and disciplined enough to hold on to it, and we see the breakout, and I say, hey, we cross above the 23.6% level. If we cross and close back below, if it looks like this wasn't going to happen, then I'm going to get out of the trade. I don't want to hold the trade through a Fibonacci projection reversal. We went up to 23.6. We did test it again, but we never really closed below there. 38.2%, well, after we crossed above that and closed above that, we never really came back below. 50, 61.8%, then we see the market start to consolidate here, and the next thing you know, we have a reversal. We have candlesticks that closed below, candlesticks that broke the former highs, became new lows, and this is clear to see that we now broke that level. We could even go so far as to draw trend lines and find a different way to take profits. And look at that. We would have gotten out hopefully near the 50% level. So that's how we use different time frames. Now, there was another question that was also very, very good. I'm trying to remember which one it was. Just scrolling back in the chat over here. Okay. Oh, yes, exactly. Do I buy the breakouts? The question was, do we buy breakouts? Now, that's a very, very good question. Let's go back to a daily chart, and I'm going to answer that question as well. In the foreign exchange market, and this is something that a very wise trader taught me at one point. I asked this very, very smart trader a long time ago, I said, how do you look at the market? I like to tell this story. I love this story. How do you look at the market? Do you use Fibonacci? He said, yeah, sure, I use Fibonacci. I said, do you use Elliott wave? He said, yeah, sure, sometimes Elliott wave. I said, well, what do you think? What's the best way, for especially someone new to foreign exchange, what's the best way for me to look at the charts? And he explained to me that, if you take a look at the price of Apple computer stock or Google stock, well, we can quantify it fundamentally. How much should Google be worth, or how much should Apple stock be worth? Well, they sold X amount of iPhones, therefore the earnings per share, etc. That's left up to analyst interpretation, though. But the euro dollar at 150 tells me I am not taking a European vacation anytime soon. And there's certainly a lot of European exporters that are hurting because of this, European exporters to the U.S. We know overnight Bloomberg had a very nice article. The Bank of Japan is not very happy about the dollar-yen lately. And we'll go to the dollar-yen over here in just a minute. But if you saw the dollar-yen, we just broke the new 40-year lows back to 1995. Maybe 25-year lows. We crossed a very, very big lows on the dollar-yen going back to 1995. Now, as Japan is an exporting nation, they benefit from a weak yen because a weak yen allows U.S., European, and Australian consumers to buy more goods and services. When the dollar-yen falls so low, it costs more U.S. dollars to buy every single Japanese product and service. Therefore, it's in Japan's best interest to have the dollar-yen go up. They don't like to see the dollar-yen go down. And when the dollar-yen crosses below certain levels, parity, or not parity, but $100 yen. When $1 is worth exactly 100 yen, when it crosses below, that was big. Well, 85 is a very big level from what I remember as well. In those particular cases, and the reason why I mention this is because it's very important to look at the market in terms of horizontal price levels. Former resistance becomes new support. Former support becomes new resistance. Now, the question is, in a very roundabout way, do I buy the breakout? Would I have bought the breakout on euro dollar? The answer is no. Take a look at the former highs of 150.62. Those are the highest highs that the market on my chart just went up to. This was October 26th. This is the daily chart euro dollar. Well, my suspicion is this former ceiling, I don't think necessarily euro dollar is gonna break out altogether. Maybe it will. But my theory is that, and I've seen this a lot, is that if this resistance level is truly shattered, it should become new support. So what I like to do is wait for the market to break out. I'm comfortable letting the market go. It's not going to go a million pips without us. Foreign exchange market always gives us a second chance. After the breakout, wait for the retracement. If I had bought up at 150, 144, how would I feel? We're at 150.08 right now. Uptrending support is well below us, down at the, 146.50 level. How would I feel losing 500 pips buying exactly the top? I'm sure somebody else there probably did. I want to wait for the retracement. I want to see the market honor this level. It was resistance. It was a big resistance. We finally broke. But if we finally broke, it should become new support. And to answer that former question, I will not buy breakouts of foreign exchange markets. I like to wait for the breakout, let it happen, and then wait for the retracement. Now, the value added to this is we can draw diagonal support and resistance levels. That may justify why the euro dollar is pulled back. But I don't want to buy the euro dollar until we establish a nice support level, maybe on a Fibonacci level to boot. Okay. If there's any particular charts you want to look at, please do not hesitate to let me know. I believe I'm almost out of time. FX Street, please let me know when I'm out of time. Let's take a quick look at the dollar yen. And dollar yen goes very much in line with a lot of these other currencies. Now, draw the Fibonacci levels from the highs, the last significant highs, of August 9th or so of this year, draw them down, 38.2%, reversal. Where could dollar yen go? And that's really the question that we have to ask ourselves. Where could the dollar yen go? Let us go to the Fibonacci projection levels. Dollar yen could go to 23.6% at 85.70, 38.2% 84.30. So I would say if you are short the dollar yen, if you're fortunate enough to be short, hold on to the trade. We could certainly go lower. Now, there have been a lot of requests for gold. I have a few moments left, so I want to show you exactly what we're looking at. Price of gold is at new historic highs. Now, draw your Fibonacci levels from those former highs. Okay, from the lows, let's zoom out a little. The last significant lows I see on the gold market is the pullback we saw down to $1,026 on October 28th. Draw them up. I'm sorry. No, we have to go below that. Sorry. Go back to, take the Fibonacci levels. There we go. Draw them down to the last significant low before the breakout. That's what we have to do. So I'll give you the dates. The dates, take the lows to September 30th. September 30th, gold was down at levels below 1,985 or so. Draw them on up to the highest highs before the retracement, and we saw 1,070. We pulled back. Check out where we pulled back. Here's a 50% Fibonacci retracement level. This is the low. This is the high. 50% Fibonacci retracement level, and we held almost perfectly there. And take a look at this. Former resistance became new support. Former highs of 1,023.80 became new supports. 1,026.20. $2 difference in the price of gold. It's $1,000 an ounce. We came in with $2. Former resistance becomes new support. That's why I love it. Now, where could the gold market go? Well, we went to 23.6, 38.2. We just right now are showing a little bit of weakness at the 138.2% Fibonacci projection level. Excuse me. So gold, the thing is with gold, it could go on for a long time because we're at new historic highs. Excuse me. So almost all buyers are making money. Almost all shorts are losing money. The last chart I want to show you, by the way, is the Dow Jones Industrial Average chart. This is incredible. draw the trend line. This is Dow Jones Industrial Average, as simple as YM. Draw the Dow chart from the highs of 2007. Remember when the Dow was up at 14,000? Draw it all the way down to the lows near 7,000, below 7,000, going back to March of this year. Take a look at the 50% Fibonacci retracement level. It lines up, whoops, I erased the wrong lines. We'll draw it again so we can see. Draw the Fibonacci levels all the way down, measuring the entire aftermath of what happened. Take a look at where the 50% level is. 50% level, 10,400. Take a look at where the 50% level intersects with. Downtrending long-term resistance, uptrending intermediate resistance, and the 50% Fibonacci retracement level all fall together at around Dow 10,400. Now, there are two scenarios I think that could take place. If we see a breakout, a strong breakout after maybe tomorrow's start of the shopping season, maybe after a very big move, we see Dow 10,500. I think we have a good chance to see the 61.8% Fibonacci level. That's at 11,300. That's 900 points higher. But if tomorrow gives us some very poor holiday shopping numbers, and maybe not only tomorrow, but we have some other economic numbers that help the market along, if this is the actual top and we reverse, we have uptrending support level at around 9,600. That's 800 points. So I think we could potentially go up 900 points to the upside or 800 points to the downside. We know the Dow is very closely correlated to the foreign exchange markets, so especially the dollar. So if the Dow goes down 800 points, I surely would expect the dollar to go up a lot. I think if the Dow goes to 11,300, goes up 900 points, I certainly would expect the dollar to go down a lot. And you will see confirmation in the commodity markets like gold. You'll see stock market confirmation, and of course through the foreign exchange market. So we're at very, very crucial levels. We have an intersection of the 50% Fibonacci level. We have downtrending resistance lines to intersect and uptrending resistance lines to intersect. And lo and behold, take a look at some of our other charts. Euro dollar yesterday went to new one-year highs. Dollar yen, 1995 lows. Dollar Swissy, one-year lows. Aussie dollar, we're moments away, not now, but we were moments away from a one-year high. So we've hit on the dollar crosses, on the Dow, and in certain commodity markets, critical highs and lows for at least 1 year going back. They all measure up to some sort of Fibonacci level, and I think can be very, very useful to try to find the next big move. With that said, to answer your question, I do not use Fibonacci arc and fan. I have in the past. Nothing wrong with it. I just like my method a little bit more to use that one. With that said, I'm just about out of time. If you have any questions, you can contact me directly at www.forexlounge.com. I want to thank you all very much for joining us. I also have a very special thanks to FX Street. Please see the calendar because we'll be back on with much, much more next month. Again, contact me there if you have any questions. We wish you all a fantastic day, a very, very, very happy Thanksgiving, a pleasant weekend, all profitable trades, and we look forward to seeing you.